about property, because quite often that is the big asset that a couple own together. Let's talk about their primary principal residence. Did I get that right, Paul?
Slightly, just about, yeah. I'll let you off.
So their main home, as I'd say in layman's terms. So talk to me about what tax implications there might be with a couple owning a home together, and if there's a mortgage on the home and so on.
So I think at the most basic case, I guess if one spouse as part of the divorce transfers their half of the property, let's say, to the other spouse, then provided we meet the requirements for a tax-free transfer, there's no tax issues at all. If the spouse transfers it and they've lived, in the property for the entire ownership period, again, there's no tax issues because it's been their primary residence throughout that period. Where it starts to get complicated is if one spouse moves out and then the property's sold down the line, because the principal private residence relief is dependent on that actually being your principal private residence. So if one of the spouses has moved out and then they jointly sell the property, it's conceivable the spouse who's moved out may end up with a capital gains tax charge because they've not occupied that property as their principal private residence for the entire period that they've owned it. Right. Now there is a rule that says if you move out, you've still got the last 9 months of your ownership period is also treated as being as if that was your principal private residence. So it's conceivable. And if they've owned a property for 30 years and they're out of it for 6 months, you're talking about, small bit.
However, in Henry's example just now, if you've been out of it for 9 years, then there are issues. And I suppose then, Henry, is that something that can be looked at as part of the financial settlement so that one isn't particularly out of pocket in terms
absolutely.
of tax?
I mean, that's what you've touched on there is exactly why we need input from tax experts, because part of the challenge in when you're dealing with a financial settlement upon a divorce is to establish what the asset base is and what that asset base is worth. But of course we look to identify the net worth rather than the gross value. So quite often cases we deal with, there might be not just the main family home, there might be a holiday home or properties in other jurisdictions.
You just got ahead of me there. I was going to ask about you give us a lovely scenario of a principal private residence, a main home, obviously owned jointly, and perhaps the couple is going to sell that and split the odds, but then maybe they have a property, a holiday let in Wales, although with current legislation and tax on properties in Wales and holiday homes and furnished holiday lets, maybe not a good idea. And then maybe a flat in London which they bought together whenever they were first married before they moved out to the country. What happens there? Because do they have to sell all three of them, or can you transfer one to one and one to the other and kind of almost swap? How do you work that all out?
Yeah, you can transfer. I mean, quite often it's very common, in fact, that there might be an acceptance that the main home has to be sold, because usually that's where the majority of the equity is kept. But there might be, whether it's financial or emotional ties to other properties, so one party might want to keep that property, which they can as part of the settlement, providing the numbers balance out. And again, this is exactly why the tax angle is really important, because what we don't want as solicitors is to oversee a couple or a client agreeing a deal only to find out later down the line that actually there's a big tax bill coming their way. So it's important to establish almost at the outset, or certainly before an agreement is reached, what the actual true net value of the assets are and what the tax implications are of a transfer or a sale, whether it's immediately or later down the line, so that the parties know exactly the true extent of the financial settlement they're signing up to.
Oh, that's really interesting. You've got me thinking about all sorts of things now, and I'm going to come back to that, but I'm just thinking, well, how do you do that with regards to a pension, for example, or a final salary pension? Because I suppose if somebody, and I suppose this is stereotypically, but often if a wife gives up work to look after children and genuinely has had a great career, gives it up to look after the children, and therefore doesn't have much of a pension, but maybe the husband has a huge pension potentially. You know, that and property, you can be very asset rich but cash poor, so it can be quite challenging, I'm sure.
Well, it is challenging, and pensions are a whole category of their own in terms of when you're looking at a divorce, and usually, not always, but in most cases, we will engage the services of an actuary to do a report on a joint basis, so report to both parties to sort of advise on the appropriate pension sharing order that should be made, and then within that report they look at the benefits and the income that the pension will produce in retirement, and that would include some tax advice as well. But you're right in that quite often, whether it's a husband or a wife, they might have different priorities. So again, without being stereotypical, a wife might think, well, I'm not that bothered about pensions, I'd rather have more property now or cash now, and the husband might think, well, I've been paying into that pension since I was 18, that's really precious to me, and I want a good lifestyle in retirement, and so the pension might be more important to him. And so then there can be a bit of a trade-off between
absolutely, and I suppose this is where it's so important to engage not just professionals who are expert in the field, but professionals who have seen this happen time and time again, and who can objectively, you know, describe and detail the potential pitfalls and the pros and cons of different situations and different answers, because people can get very stuck in either the now and what's right in front of them, what's urgent right now, and maybe not see the bigger picture.
Yeah, that's it. I mean, I'm sure Paul's the same with his clients, in that quite often I will say to a client in the initial meeting, what's your objective?
Yeah.
They might not know, of course, but you know, if it's important to ask at the outset what their at least initial objective is in terms of which asset they might want to retain or where they want to live, what sort of so that can then shape the direction of travel as to how you approach.
Yeah, I mean, I think that's 100% right from my perspective as well, because too often people will almost become obsessed with the tax consequences, not just in this scenario, but more generally. It's actually, you know, what do you actually want to achieve, and let's understand what the tax outcomes of that are at that point, and then if we can finesse that to achieve, you know, the better outcome, which might involve some compromises, then absolutely. But let's not make decisions just based on, you know, this is going to get us the optimum tax position in this scenario, because if you save a bit of tax now but end up owning a property which you really don't want down the line because that was the most tax efficient way to do it, you know, short-term gain, long-term pain really in that scenario from my point of view.
So tax and divorce, two of the most emotive topics and situations to find oneself in.
Absolutely.
Right, I'm gonna whiz back, I didn't say circle back because that really irritates me, to the previous scenario there where we said about a main residence and a Welsh property and a London property. Any tax implications on those, Paul, that you can see?
Well, again, if you think about capital gains tax, it really does depend on the timing, and to go back to Henry's point, if there's a court order in place, then effectively, if the transfers are under a court order, then there's no capital gains tax to worry about here. If we're not got a court order, then we are into this. If it happens within, you know, the 3 tax years following the tax year you separate, then it's fine from a capital gains tax point of view. After that, you know, potentially you've got to value the half share that's getting transferred, and that might be a sale at market value as far as the capital gains tax rules are concerned. Happily, the stamp duty rules are fairly concessional in that effectively there's no stamp duty if a transfer of property takes place in connection with a divorce. It doesn't really matter when.
So you've got longer than the
you essentially, as long as it's in connection with a divorce, the arrangements that have been agreed as part of the divorce, then effectively the stamp duty is relatively benign in that situation.
Okay, that's interesting.
And I guess the other one is inheritance tax. And again, just to make life more interesting, there's different rules for inheritance tax as opposed to capital gains tax and stamp duty. So from an inheritance tax point of view, spouse transfers are exempt from inheritance tax. And as long as the marriage is still in existence at the time, so I guess the final decree hasn't been issued, as long as the marriage is still in existence, that will still be an exempt transfer from an inheritance tax point of view, but if it happens after, then it will be, from an inheritance tax perspective, a potentially exempt transfer, and you're into the whole conversation around the 7-year rule, and potentially if the person making the transfer dies within 7 years, that property's back into their estate.